And at one point in time, the Nifty actually dipped below 7,400. As you can see, that sharp cut coming in there. But then there was a pullback towards the end. In terms of the constituents of the up move, where the strength continued coming in, it's commodities all the way. We've seen some very solid moves on stocks like Kane India, Vedanta, Hindalco and ONGC. So commodity as a play was very strong today. Banks, once again, a mixed picture. And the volatility on the Nifty bank mirrored that on the headline index, the Nifty itself. And that mixed picture is quite evident. If you're looking at something like a Bank of Baroda, which was in positive territory, State Bank, ICICI Bank, even a Yes Bank today, some of these counters were under pressure. So that's the shape and nature of today's market action. What next? Well, we're joined by Nitin Raheja of Rada Advisors. Nitin, thanks for being with us on the show this evening. Well, it's, it's complete whipsaw either side. It's been, fairly severe, the moves that we've seen in the last fortnight or so. What's your advice? I mean, is this volatility going to continue? And if it is, then how to deal with it?
Well, I think, the volatility, at least in the short term, seems to be here to, here to stay. You have this whole issue of, oil coming down and thereby causing a, scare in terms of the overall impact on the global economy, moving into a slowdown phase. You have the U.S., which, where some of the top CEOs have talked about the fact that the U.S. is, might get into a recession. And, conversely, you've seen the dollar actually starting to, from its strength, starting to retrace a little bit of late. So I think there's complete lack of clarity and confusion as far as the global economy is concerned. So I think you will see volatility sustained for some time, at least in the near future. I think the two key triggers to watch is that, if you start seeing oil starting to stabilize and the dollar starting to weaken, maybe you will start seeing the markets, gradually starting to, ease out and stabilize as such. But, more closer to home, I think out here, even what you're seeing, the story is that the whole rally of last year, which was a very narrow rally focused on stocks, which resulted in some stocks getting into, a kind of a overvalued zone. So when you're seeing the first signs of the risk-off trade, you're seeing sell-offs taking place. Companies whose earnings are not justifying the kind of valuation that they're trading at, getting sold into. So I think all in all, we are looking at a phase where we probably will see volatility mean that the markets are basically going to be choppy. My own guess is I think they will go and test the levels of 7,200 odd that we saw last week or the week before once again.
Okay, Nitin, so that's important to keep in mind. Just want to point out to our viewers, the one silver lining of today's action is that today we didn't at least get a hat trick in terms of the selling from the DII fraternity. Last 2 days, they were sellers in the cash market. Today, they've become buyers once again. So that's some sign of confidence for the bulls at least. And they've bought stocks worth almost 475, 76 odd crore rupees. FIIs once again on the sell side of the screen. Nitin, you mentioned corporate earnings, and that's what I want to come to next. We are, almost 80% through the season. A lot of big companies are yet to report, and that will happen in the last leg. But what's your takeaway so far? Are the numbers giving us enough comfort? Do they justify where the market is right now?
Well, clearly, I think, the markets are weighed down by the kind of numbers that we've seen as corporate earnings in India are concerned. The earnings have basically followed the trend we saw where there has been no clear direction. The earnings growth has been very tepid. Again, you've seen, even within sectors, you've really seen individual stocks do better than the sector. So overall, really you're seeing the phase of low earnings or almost flat earnings continue for the market as a whole.
Speaking of earnings, let's straight away get to it. And it's a huge, big earnings miss. The street never really is happening in the space, Nitin. Is there something that you like in cement?
Well, I think what you're seeing in cement is the incremental capacity that is coming up is not that high, and plus, with all the problems with getting access to limestones and mining related issues, I think a lot of this consolidation of capacity is taking place because those deals are happening at far cheaper levels and valuations. So cement as a sector, we are positive on the long-term basis. and within that, we would really like to look at some of these mid-cap cement players who are kind of consolidating, and where valuations are are typically yet going in the range of anywhere between 50, 60 to $80 a ton.
Okay, well, that's the call on the cement space. That's Birla Corp. Let's see what reaction we get tomorrow. But coming back to earnings, and there have been plenty. How have you read some of the performance that we've seen in the earnings season? Are there any companies that have stood out for you where you want to go ahead and take positions now? What is it that you would buy? I mean, even though you're looking at the market perhaps slipping back to 7,200, if you would buy something, what would it be?
So I think, again, I would look at this from a perspective that wherever the corrections have been pretty steep, on a pure, bottom-up orientation basis, with a bias towards consumption stories. Because clearly the way we see this is that consumption stories have delivered better numbers against infrastructure and other sectors. So I think further with the pay commission hike coming in, and also an expectation of monsoons being good this year, which is what everybody seems to be.
Sure, but Nitin, let me Nitin, but
I think.
Let me actually ask you this. What part of consumption? It's a very wide basket. Are you talking autos? Are you talking staples? Or are you talking about some of the companies? I was just reading out a lot of earnings that came out, including Talwarkar, TBZ, etc. All of this is a play on consumption in different pockets. So which part do you like?
Right. So, I think clearly we like the autos pack among the best. We like some of the NBFCs who are quasi and fueling this whole consumption boom. We've seen some of those results come out in the last few days. We like some of the private banks with a focus on consumer lending. We like some of these, so-called entertainment companies, especially on who are more focused on the exhibition side as such. We think some of the second-tier consumer names are looking a little attractive from a valuation, because the first-tier names are really, we just don't, understand the valuations vis-a-vis the growth equation that they trade at. So this is some of these, areas. So some of the discretionary consumption areas is what the companies are what we are looking at.
All right, Nitin, good talking to you on the show today. Thank you so much for joining in. We'll take a quick break on that note, a technical chat on this market when we come back. Stocks have anyway fallen 40 to 50%. They are very, very far away from their 52-week highs. Off late, we've seen some kind of a counter-trend rally. I mean, maybe a technical rally, or call it bottom fishing. What we've seen today, for instance, when all of these counters, including a Hindalco, including Kane Vedanta, they were all running up very hard. Would you look at buying this dip right now? Are we anywhere close to the bottom?
I think the rallies you're seeing are more led by news, like, for example, the news that came today in terms of China saying that they will try and curtail the excess capacity in steel and so on and so forth. So I think there was kind of a relief rally with the expectation that the kind of dumping that we've seen, going off the ground. But I think it's too early days from a pure fundamental perspective, because the kind of prices of finished goods that have fallen vis-a-vis the raw material raw material prices have fallen less than what the finished goods. So the margins are under squeeze. So really, even if this whole episode of China were to happen, you'll probably see finished good prices inching up. But then you're sitting on so much of surplus capacity, and then you have balance sheets which are stretched with leverage. So I think, fundamentally, it's and plus compounded with the fact that demand is really not picking up at the macro level. So in this situation, I think it's too early to call on commodities at this stage.
All right, Nitin, on that note, we'll take a very quick break. When we come back.